One thing I've noticed on YouTube, especially, and this is mainly prevalent within the value investing community, is that most value investors tend to embrace the type of investing approach that they take and discard other investment approaches. So today I'm just going to give a brief description of both value investing and growth investing, and I would try as much as possible to describe both and give examples of companies that fall under this category. So let's take a look at value investing. Value investing is an investment philosophy that involves buying stocks that appear underpriced, having carried out some fundamental analysis. These are stocks in public companies trading at discounts to book value or tangible book value, those with high dividend yields and those having a low price to earning multiples or low price to book ratios. High proponents of value investing includes Warren Buffett, who proposes that the essence of value investing is buying stocks at less than their intrinsic value. The discount of the market price in this intrinsic value is what is called the margin of safety. Value investing is rooted in the rejection of the efficient market hypothesis, also called EMH. While the EMH proposes that securities are accurately priced based on all available data, value investing proposes that some equities are not accurately priced. As such, value investing is about exploring the inefficiencies in the market and fully exploiting these to the value investors' benefit and long-term gain. So examples of value companies are JP Morgan, Costco, and Home Depot. Growth investing, on the other hand, is a style of investment strategy that is focused on capital appreciation. Those who follow this style, known as growth investors, invest in companies that would exhibit signs of above average growth, even if the share price appears expensive in terms of metrics such as price to earnings or price to book ratios. In typical usage, the term growth investing contrasts with the strategy known as value investing. In contrast to value investing, growth investing is when the investor chooses a company that has yet to reach its full potential to invest in. The type of investing requires the investor to do a lot of research to find companies that have the potential to grow rapidly and compete with other larger companies within its field. Instead of investing in an already established company, the investor takes a higher risk in the hopes that the company grows and makes him or her money. Growth companies are companies that have the potential to grow at a rate that is higher than the market's average. A growth company typically has some sort of competitive advantage, a new product, a breakthrough patent, or overseas expansion that allows it to fend off its competitors. Larger companies typically pay dividends to their stockholders, but growth companies would often reinvest their earnings in an effort to grow the company. These companies are becoming more popular to invest in because they show great potential. This potential typically roots from the company offering a unique or an advanced product that is ahead of its competitors' products. So examples of growth companies are Google, Amazon, and Tesla. Growth investing seems to be snubbed a lot, but growth investing normally outperforms the S&P 500 in a bull market, but would typically underperform in a bear market. Recently, one of my favorite YouTube finance channels, Joseph Carlson, said he was disposing of his T. Rowe Price stocks because they were underperforming. If you understand T. Rowe Price, it takes a growth investment strategy approach and will typically underperform in the current market conditions. So I hope you found this useful in terms of the investment strategy you like to take. I must add, there are those investors who adopt both investment approaches in their portfolio. At the end of the day, it all depends on your risk profile in terms of the investment strategy you want to adopt. So let's review the performance for the past week. The month of July has been the best performing month this year to date. The portfolio saw a 19, almost 20% increase in value, even though the portfolio is still at a loss. We'll come to the actual figures in the next set of slides. So July has been an amazing month and we look forward to what August would bring. So there's been no change in the portfolio over the past week. As you can see, majority of the stock in this portfolio are in the green, with only 3 in the red, namely Amazon, Genius Brands and Lucid. Amazon is one of the companies that released their quarterly results this week and it was quite impressive. So there's been significant improvement in the profit loss position of this particular stock. Here's a quick overview again of the stocks in the experimental portfolio. As you can see here, Lucid is still the largest loss maker and the most profitable position is Rivian from a percentage viewpoint. In the current week, the size of the portfolio still remains the same from last week. The loss has reduced to $3,235. The total equity has increased by almost $2,000 and the overall loss on the portfolio is down to 8.93%, which is under 10%. And the performance against the S&P 500 over the last week is 2.86%. And as I mentioned before, you can see here that the improvement from last week is $2,161. The weekly performance of this portfolio against the S&P 500, you can see here that is up 7%, whereas the S&P 500 is up 4.15%. Thereby, the experimental portfolio is outperforming the S&P by 2.86%. From a monthly perspective, the portfolio is up 19.72%, whereas the S&P 500 is up 9.11%. Hence, the experimental portfolio is outperforming the S&P 500 by almost 11%. And year to date, this portfolio has been up 19.9%, whereas the S&P 500 is still down 13.89%. Thereby, the experiment portfolio is outperforming the S&P 500 by 33.79%. I hope you found this information useful. Remember, this is an experiment portfolio and it's not meant to be copied. If you have any questions, drop me a comment and why not subscribe and like this video, and I'll speak to you next week. Take care. Bye.